back to JPX and market weekly updates. Crude futures Monday were higher, building on the previous session's rebound as focus flicked back to supply concerns as nuclear deal with Iran seems to fade further away, and threats to Russian crude oil supplies with the price cap set to kick in during December, while the United States has ruled out further releases from the SPR beyond October after initially indicating the policy could continue. Besides a sharp drop in Caspian oil pipeline loading schedule has also tightened supply expectations. Crude oil benchmarks were heading for weekly losses prior to last Friday's recovery, with most damage done on Tuesday and Wednesday when markets were swept by concerns over demand slowdown as COVID restrictions were rolled out across China, while the symbolic 100,000 barrel per day OPEC Plus reduction did little to calm the nerves. The front-month to third-month crude oil future price spread is a measure of market backwardation, a market environment that encourages crude oil to flow out of inventories and into the market. The decrease in backwardation of all crude oil benchmarks in August suggests that market calls to draw oil from inventories have decreased since midsummer, indicating market conditions that are more balanced between supply and demand than earlier this year. With the market tied between demand concerns on the one side while potential supply shortfall provide a counter, the EIA estimates that crude oil prices will generally remain near August average levels through the end of 2023, and the possibility for significant volatility around those averages is high. On the demand side, the micro picture continues to be dominated by recession in Europe and COVID in China. Asia gasoline crack spread were broadly flatlined for the past week, as personal mobility in and around big cities in China has slumped about 20% in the first week of September compared with the last week of August, as government announces travel restrictions on an increasing part of the population. These controls are likely to last until the end of October, according to media reports. Tighter restrictions were seen as the first drag in China's oil demand, at least in the short term. The impact of energy crisis in European markets has been particularly pronounced. Reductions of flows to Russian energy, including the Nord Stream 1 pipeline shutdown and looming rollover price caps, may cause a short-term price increase. However, this is likely to be offset by economic damage. The looming recession in Europe and winter energy crisis also weigh on the negative sentiment these weeks. There are widespread fears that European industry will suffer a sharp slowdown amid energy shortages. For instance, high energy prices are already putting the viability of steelmaking in Europe at risk and have forced numerous mills to halt installations. In Europe, the PMI value dropped to 49.8, also its lowest rating since June 2020, contributing to further concerns about economic conditions and petroleum demand. Little support came from the United States, as the latest data from the EIA revealed gasoline demand ticked up by 1.6% to a 3-week high, but still remains 7% below its 5-year average for the week, while distillate demand was also up 1.6%, but down 3% from its 5-year average. Inventories of crude oil, gasoline, and diesel all rose in the last week of official driving season, though the large increase in crude oil inventories was caused by the release of strategic stocks. In response to the war in Ukraine, the United States announced a plan at the end of March to release 1 million barrels of oil for 6 months, including 30 million in September and 32.6 million barrels in October from the SPR. When the plan was announced, there were warnings that could backfire, pushing prices higher instead of lower because the SPR would need to be replenished after this substantial draw. The current SPR release plan is scheduled to expire at the end of October, even as uncertainty about Russia's supply of energy remains very high. Reuters reported that a Department of Energy official said the White House was not considering new releases from the SPR at this time. Meanwhile, OPEC producers may consider further production cuts to counter the drop in Chinese oil demand, with Saudi Arabia potentially considering a short-term unilateral cut, though most members continue to struggle with existing targets, as output from the 19 countries with quotas under the agreement fell 3.6 million barrels short of target last month, the widest gap in the alliance's 5-year history. Okay, that's all for this week. For more information, please stay tuned to the JPX Energy Market Weekly Updates.